The U.S. pharmaceutical industry is confronting a potential $51 billion annual increase in drug costs due to proposed 25% tariffs on imported medicines. It's not just a pricing issue, it's a supply chain reckoning. In this analysis, we look beyond headlines and earnings to examine how structural shifts are reshaping the U.S. pharmaceutical landscape and what that means for market leaders, rising challengers, and the future of American healthcare.
We now proceed with the value chain analysis of the rivals. Pfizer maintains strong governance supported by a diverse, independent board. Its human resources team manages over 80,000 employees, offering global training and centralized support. In technology, Pfizer leverages AI and cloud innovation to accelerate drug development. Procurement follows a category-based model, partnering with CMOs under strict EHS compliance. Inbound logistics involve third-party coordination and ethical sourcing. Its operations span 36 global sites with over 115 pipeline projects. For outbound logistics, Pfizer distributes to 200-plus countries using DHL, FedEx, and real-time tracking systems. Marketing and sales include major campaigns and platforms like Pfizer for All, while services support patients and healthcare providers through assistance programs and data portals. On the other hand, AbbVie also operates with a strong governance structure and a workforce of 55,000 employees supported by flexible, inclusive HR programs. Its technology features the ARC or the AbbVie R&D Convergence Hub platform and wearable devices in clinical trials. Procurement spans 47,000 suppliers with risk-based controls. Inbound logistics emphasizes supplier quality and continuous risk monitoring. Its operations include 14 global sites and 90-plus R&D projects. Outbound logistics and distribution reach over 175 countries, while marketing and sales leverage omni-channel strategies and corporate campaigns. Meanwhile, services are delivered through its Med and Flow platform.
Moving on to the VRIO analysis for the two companies. Pfizer's VRIO analysis indicates competitive parity across most areas. Although Pfizer invested $10.8 billion in R&D in 2024, the analysis shows it is valuable and organized but lacks rarity and faces imitation, leading to competitive parity. Similar to R&D, Pfizer's IP portfolio is valuable and organized but lacks rarity and faces imitation, also resulting in competitive parity. Key patents like Eliquis and Ibrance, worth a combined $12 billion in annual sales, face imminent expiration, emphasizing this challenge. Pfizer also has 37 manufacturing facilities across 8 countries. The analysis shows that it's valuable and organized, but the results also lack rarity and faces imitation, yielding competitive parity. For biotech expertise, Pfizer's advances in mRNA and ADC are valuable and organized, however, it is not rare and faces imitation, resulting in a competitive parity. Despite spending billions on marketing, Pfizer's brand is valuable, hard to imitate, and organized, but is not rare. The brand yields temporary competitive advantage. Overall, Pfizer mainly has a competitive parity among its resources and relies on a temporary brand reputation to keep a competitive advantage. AbbVie's VRIO analysis reveals a more challenging landscape. While valuable and organized, AbbVie's R&D lacks rarity and faces imitation, resulting in a competitive parity. IP portfolio is also in competitive parity with other pharmaceutical companies because it is valuable, not rare, easy to imitate, but has robust organization shown through strategic acquisitions. Operating in about 20 countries with R&D and manufacturing facilities worldwide is valuable, but there is no rarity and easy to imitate. Even though it's organized, the manufacturing yields competitive parity with other pharmaceutical companies. Similar to R&D, AbbVie's expertise is valuable and well organized. However, similar investments in strategies by competitors mean this capability is not rare or inimitable, resulting in competitive parity with other pharmaceutical companies. Brand strength is a valuable asset, but the analysis shows competitive parity due to ESG gaps and less global reach than Pfizer. And since it's neither rare nor hard to imitate, competitors can easily match it.
Now, I will walk you through how Pfizer, AbbVie, and Lilly compare financially. I will focus on 5 key areas: revenue and profit trends, profitability ratio, liquidity and solvency ratios, and DuPont analysis. Let us start with revenue and profit. Pfizer made $63.6 billion in sales this year, but that figure has been falling with a 2-year CAGR of negative 20.7%. On top of that, they recorded a net loss of $3.6 billion. AbbVie, on the other hand, stayed steady at $56.3 billion with a 4-year CAGR of about 5.3% and a net income of $4.3 billion. But Lilly outperformed both. We grew our revenue from $24.5 billion in 2020 to $45 billion in 2024. That is a 16.4% annual growth rate. More importantly, our net income reached 10.6 billion. That is more than what Pfizer and AbbVie made combined. Even though Lilly posted the least revenue among the three companies, it outperformed both Pfizer and AbbVie in terms of net income and revenue growth rate. Looking at operating margin, this tells us how much profit each company keeps from every dollar of sales. Pfizer leads with 31.6%, but they still posted a net loss. AbbVie trails behind at 16.2%. Meanwhile, Lilly posted a 30.5% operating margin, nearly as efficient as Pfizer but without the financial losses. That makes our margin much more meaningful. Now, onto liquidity, or how well each company can pay off its short-term bills with cash. Pfizer has a cash ratio of 0. AbbVie and Lilly are both slightly better at 0.1. But none of us are in ideal positions. This means all the companies rely on more than just cash to cover their short-term obligations. Next is financial leverage. We are looking at how much debt a company uses to fund its assets. Pfizer is at 2.4, a fairly conservative figure. AbbVie is at an alarming 40.2, which signals heavy debt reliance. Lilly stands at 5.5, higher than Pfizer, but still in a reasonable and stable range. Compared to AbbVie, we are playing it a lot safer. Then let's proceed with the activity ratio. First, let's look at their investments in R&D. Pfizer spent 17.2% of its sales on research and development. AbbVie raised that to 27.6%, but Lilly leads again, investing 31.7% of our sales into R&D. That shows Lilly's commitment to finding long-term breakthroughs and not just short-term wins. Second, let's also look at how fast we move our products. Pfizer holds inventory for 222 days on average. AbbVie does better at 90 days. Lilly, however, holds inventory for 329 days. That's a bit long and signals that this is something we need to improve on, especially as we scale faster than the others. Finally, let's break down return on equity using the DuPont model. ROE tells us how much return we're giving to shareholders. It's made up of three parts: profitability, efficiency, and leverage. First, in terms of profitability or net income, as a percentage of sales, Pfizer is at negative 0.5%, AbbVie is at 7.6%, and Lilly is far ahead at 23.5%. For efficiency, or how much sales we get from our assets, Pfizer and AbbVie are both at about 0.3 to 0.4 times, while Lilly is higher at 0.6. Finally, in terms of leverage, as mentioned a while ago, Pfizer is at 2.4, AbbVie shoots up at 40.2, and Lilly stands solidly at 5.5. Putting all three together, Pfizer ends up with a negative 4.1 ROE. AbbVie posts 127.4%, but that's mostly because of its massive debt. Lilly, by contrast, delivers a strong 74.2% ROE, driven by real profit and smart, manageable leverage. So what is the big picture? Pfizer is still trying to recover from its post-COVID peak. AbbVie is steady but dangerously dependent on debt. And Lilly, we are growing faster, investing more in innovation, delivering real profits, and giving back strong, sustainable returns to shareholders. But while Lilly is ahead in profitability and growth, operational efficiency, particularly in inventory management, remains an area for improvement.
To better understand this competitive landscape, we also examine the strategies each company employs. Pfizer follows a product differentiation strategy focusing on rare diseases, internal medicine, oncology, vaccines, and anti-infectives. It operates across 69 global sites and serves approximately 180 countries. Recent strategic moves highlight its growth focus. Pfizer partnered with Triana Biomedicines and Crossbow Therapeutics for emerging therapies and committed $1 billion to expand R&D in China under the Pfizer China 2030 strategy. For its functional strategies, Pfizer drives R&D pipelines, improves manufacturing efficiency through its optimization program, and connects with patients through omni-channel marketing like Pfizer for All. It strengthens biotech partnerships and advances ESG goals across access, sustainability, and ethics. AbbVie also follows a differentiation strategy, specializing in high-value areas like immunology, oncology, neuroscience, and emerging obesity treatments. Its global reach covers over 175 countries, supported by a strong network of more than 1,000 suppliers. Recent moves shows its push for growth. A $2.2 billion deal with Gubra to enter the obesity market, new approval for Rinvoq in Europe, and acquisitions of Cerevel and Immunogen to boost its neuroscience and cancer pipelines. Functionally, AbbVie speeds up R&D through cross-functional teams managing over 90 active programs. Its manufacturing stays is flexible with dual sourcing and real-time supplier tracking. In marketing, it uses digital platforms like Salesforce to improve doctor engagement. Partnerships with biotech and strong ESG practices like climate risk reporting and patient access programs also supports its long-term strategy.
Now let's assess how these strategies translate into each company's strengths and weaknesses. Pfizer's main strengths are its strong global brand and trust, especially after its success with the COVID-19 vaccine, which has built confidence among patients and healthcare professionals. The company is a major player in cancer treatments with over 50 oncology programs in development and more than 24 approved cancer medicines, positioning it for future growth. Pfizer fosters innovation through an extensive R&D network and strategic partnerships including the Seagen acquisition, AI integration, and Blackstone funding, which accelerate drug development. Its global supply chain with 37 manufacturing sites supports reliable product delivery and operational efficiency. Despite these strengths, Pfizer faces notable weaknesses. It spends a lower percentage of revenue in R&D than some competitors, which may slow long-term innovation. Additionally, while brand trust strengthened after the pandemic, Pfizer's revenue has been volatile as demand for COVID-19 products declined. AbbVie's strengths lie in its strong investment in research and development, with $12.8 billion spent in 2024 and about 90 treatments in the pipeline. The company focuses on important areas like immunology, oncology, and neuroscience, boosted by strategic acquisitions like ImmunoGen and Nimble. AbbVie also benefits from partnerships with biotech firms and early-stage startups, helping it stay at the forefront of innovation. AbbVie has a strong presence in immunology and oncology, with drugs like Skyrizi and Rinvoq. However, AbbVie still faces challenges. Although these products have become the primary revenue drivers, the company remains heavily dependent on these blockbuster drugs. This means any setbacks with these products could significantly impact AbbVie's financials. The brand lacks broad global recognition beyond its key products, which can limit market presence. Additionally, clinical trial failures like with emraclidine have led to costly write-downs, and rapid acquisitions have created integration challenges, adding complexity to managing a large global workforce and operations. Moreover, certain aspects of AbbVie's operations are also highly dependent on third-party suppliers. AbbVie procures some products and services from a limited number of suppliers and in some cases relies on a single supply source, which increases the risk of supply disruptions.
Now, let's explore how different external events pose either threats or opportunities to firms in the U.S. pharma industry through a PESTLE analysis. Let's start with the political and legal environment. Government policies like Biden's Medicare price negotiations threaten industry profitability, which aim to lower drug costs. This challenges revenue for big pharma. However, there's also an opportunity. Many CEOs have begun lobbying the new Trump administration to push for more profit-friendly reforms, like restrictions on pharmacy benefit managers' rebates. Next, pharmaceutical goods are usually tariff-exempt due to the involvement of human lives. However, Trump's proposed tariffs on pharmaceutical imports, especially from China and the European Union, pose a major threat, especially to generic drug makers who rely on low-cost active pharmaceutical ingredients or APIs, or to firms that have manufacturing plants in Europe. These increased costs can reduce accessibility and strain supply chains. Lawsuits are another legal threat. For instance, legal actions against Lilly and Pfizer over product safety and misrepresentation could cost billions in penalties and cause long-term reputational damage. Economically, rising interest rates and inflation increase borrowing and operational costs, pressuring profit margins. That's a threat. But there are opportunities too. U.S. health spending hit $4.9 trillion in 2023, and increasing household income by 7.5% in 2023, the highest growing rate observed since 2003, allows more Americans access to both essential and premium medications. Socioculturally, the aging U.S. population and the global rise in obesity create huge opportunities for pharma companies. More chronic illnesses mean higher drug demand. But the growing trend among Gen Z and millennials for wellness and preventive care, like purchasing products and services that improve overall health and appearance, might reduce long-term pharmaceutical use, which is a potential threat. In the technological sphere, innovation is a clear opportunity. AI, automation, and digital platforms are reshaping drug discovery to manufacturing and distribution. Firms that embrace these tools can gain speed and efficiency. Pharma companies could gain up to $155 billion in additional operating profits by 2030 if they adopt AI. However, dependence on IT infrastructure also introduces threats. Cyber attacks or system failures can disrupt global operations and compromise sensitive data. Lastly, pressure is mounting in the environmental aspect. While the shift toward green chemistry and emissions reduction is an opportunity for firms to lead in sustainability, most still lag behind. And that's a threat. Stricter waste regulations, climate change disruptions, and mandatory sustainability reporting can impact operations, especially for companies not yet environmentally aligned. Using Porter's 5 forces, we will analyze the competitive pressures within the U.S. pharmaceutical industry. Let's begin with the threat of new entrants, which is low due to extremely high barriers to entry. New firms face steep costs in R&D, clinical trials, and regulatory approval. often requiring years and billions in investment. Incumbents benefit from economies of scale, strong IP protection, and brand dominance, making it difficult for newcomers to compete and capture market share, despite the industry being highly profitable and demand for medication continuing to rise, especially for chronic and lifestyle diseases. While some startups emerge through biotech spin-offs or partnerships with tech firms like Samsung Biologics, they usually target niche markets or are acquired through scaling. Now, the threat of substitutes in the industry is moderate. While patented drugs dominate, rising healthcare costs and consumer demand for affordable options drive interest in generics, biosimilars, natural remedies, and preventive care. Digital health advancements like wellness apps and telemedicine also offer alternative solutions to traditional pharmaceuticals. Though not all substitutes offer the same efficacy, the shift toward holistic and cost-effective healthcare pressures drug makers. Next, we look at the bargaining power of suppliers. While there are many suppliers for general pharmaceutical materials, firms often rely on a few suppliers for specialized inputs like patented APIs. Their alternative suppliers are limited and switching costs are high due to regulatory compliance. Some suppliers may even threaten forward integration by producing generics, although very rare. But pharma companies usually engage in backward integration to reduce dependency. Thus, the bargaining power of suppliers is high for specialized suppliers, and particularly those providing patented or highly regulated inputs, while it remains low to moderate for commoditized raw materials that are widely available in the market. The bargaining power of customers in the industry is mixed. There are millions of end users, but large buyers like governments and PBMs purchase in bulk, giving them high leverage. Switching costs are low for generic drugs, but high for patented or life-saving medications. Buyers rarely engage in backward integration, but their budgets and cost pressures, especially in public health, increase demands and negotiations for lower prices. Thus, the bargaining power of buyers is high for large institutional buyers such as government agencies and pharmacy chains, but low for individual medical patients. It is also low when purchasing patented or specialized drugs, where alternatives are limited, but high for general or generic drugs where price sensitivity and competition are greater. Industry rivalry is intense among 1,906 brand name pharmaceutical manufacturing businesses in the US as of 2024. The large established players are equal in size and power, competing on similar fronts: innovation, pricing, and speed to market. Certain mature drug categories face stagnation or decline, like when their patents expire, heightening competition. High fixed R&D and marketing costs, product homogeneity, and low switching costs encourage price wars, especially for generics.
In pharma today, inventing the next big drug isn't enough. Where a firm stands on a strategic map decides whether it leads or fades. We mapped firms across two axes: geographic reach, measuring the number of countries they serve, and R&D intensity, measuring how much they invest in innovation relative to their sales. These two variables highlight how firms balance building broad market access with innovation for future growth. While the VRIO Analysis focuses mainly on Pfizer and AbbVie, other firms are included to show broader patterns, highlighting which firms have made similar strategic choices and where they stand. On this landscape, Lilly and AstraZeneca cluster together, both showing high R&D investment and strong geographic reach. They prioritize innovation while maintaining global access, competing head-to-head for innovation leadership. Merck & Co., a cross-group rival, stands even higher in R&D with broader reach, giving it a strong differentiated position. Meanwhile, Pfizer and Johnson & Johnson dominate geographic reach, winning through scale rather than outpacing others in innovation. AbbVie sits behind the global leaders in reach. What this all means is that the strongest positions are held by firms with either dominant global reach like Pfizer and Johnson & Johnson, or firms with high R&D intensity and broad reach, like Merck, Lilly, and AstraZeneca. These groups are best placed to grow because their strategies align with where competitive advantage is shifting. Which sets the stage for the next question. With pharma industry under pressure from faster drug development, tighter regulations, and unpredictable supply chains, what will separate the winners from the rest? It starts with innovation. Not just R&D spending, but real transformation. Companies that embed AI into their discovery process, that use automation and real-time analytics to cut years off development cycles. They aren't just moving faster, they're rewriting the economics of drug development. In this business, the pipeline is the future, and if you're not building it with the best tools available, you're already behind. But speed alone isn't enough, because once a drug hits the market, it enters a maze of policy, politics, legal risk, pricing reforms, patent challenges, safety lawsuits that can erase billions in value overnight. The companies that thrive will be those that know how to shape policy, navigate complex regulations, and manage legal threats without blinking. And then there's the matter of actually making the drugs. A supply chain stretched across continents is vulnerable to almost everything: tariffs, trade wars, natural disasters, and geopolitical tensions. Leaders are now rethinking where and how they manufacture, diversifying sites, investing in climate-resilient infrastructure, and using real-time logistics systems to stay ahead of disruption. Innovation, regulation, supply. These These aren't just departments, they're the battlegrounds. And in the next decade, the companies that master all three won't just compete, they'll define the future of pharma. In the end, it won't be innovation, scale, or even strategy that decides who survives. It will be who adapts before the ground shifts, and those who stay still and refuse to change will eventually be left behind.